Good to have you with us this morning. As we mentioned in our newscast, lots of earnings to chew on today and this week. And even with a few worrisome headlines here and there, Bloomberg's strategy team noting the majority of S&P 500 companies have reported better than expected sales and earnings. Let's dig into the market's response so far. We're joined by two great market strategists, Kathryn Rooney Vera joining us, as well as Gina Martin-Adams, who's the chief equity strategist at Bloomberg Intelligence. Thank you both for being with us on a busy earnings day. And Gina, I guess I'll start with you because I cited that Bloomberg intelligence work on what has been happening. I know there are a few gloomy outlooks, but by and large, these numbers have come in better than expected. Kathryn, in terms of your reaction to that sort of overall earnings picture, what's been on your mind so far?
Well, Gina mentioned it, and tech and communications should continue to do well in the environment of a market that's expecting the Fed to cut rates. Once that changes, then I think the picture follows suit. The picture specifically for the cyclical sectors and names that are more vulnerable to rate moves. My perspective, John, is that we are not in recession, and we probably will not see aggregate demand contract in 2023. But that is something that I expect to be the next phase of the economic cycle. So I think the market's going to be largely disappointed this year with regard to what the Fed does. And that's all important, I think, and continues to be from the perspective of the equity market. So yes, in the near term, you could still have a nice run. But I am advising my clients to remain largely defensive and positioned for the next phase of the economic cycle, which I think is going to be a downturn. And I'll just add one more point, John, which is I think something that's really not discounted into the market is that stagflationary scenario where the Fed, yes, pauses and keeps rates higher for longer. But if, in fact, inflation does not descend to that 2% target, and I mean to that 2% target, then the Fed's not going to be cutting. In fact, my contention is the Fed could resume rate hikes. And if that's the case, then I think that we need to be very, very cautious with our portfolios.
So, Kathryn, bringing it back to you, if people are trying to make sense of sometimes some bearish perspective, sometimes some bullish perspective, if you were advising people right now on parts of the equity market that you would be, at least feel a certain amount of confidence around being invested in, what would those be, Kathryn?
Well, I'll say that there's such a, you can run the gamut in terms of analysts. So some are extremely bearish, some are extremely bullish. And I think that should cause, in itself, it should cause some caution for both retail and institutional investors. I was recently at the IMF meetings in Washington, D.C., and this really came to the forefront. There's quite a breadth of perspectives. And I think under that environment, and I tend to be more bearish, I think if you have yields likely to go higher because the Fed maybe moves higher than the market is currently anticipating, then that's not good for cyclicals and for equities in general. So look, I would say in terms of the equity markets, I remain recommending overweight positions in those sectors that historically have outperformed in two phases of the economic cycle, both stagflation and recession. And those have been proven to be and have, in the past year outperformed staples, healthcare, utilities, and energy. So I'm keeping that recommendation. I do like fixed income as well. I think short duration is still attractive, and I do like gold and cash. So yes, I am certainly more defensive than a lot in the market, but I think that over the next, if your perspective is 12 to 24 months, I think that's going to play out favorably.